Hi everyone, Joe Kehrig with the Kehrig Real Estate Team, and welcome to your San Ramon Valley update for the week of July 25th. You know, one of the things that you're going to see as we get into the graphs is, like we talked about the last couple of weeks, that, you know, we are not in a real estate recession. Even though we might be in an economic recession, the real estate's not in the recession. What we went through is we went through a correction. And a correction is defined when real estate prices go down at least 10%, which in some of our areas it has. But let's take a look at a couple of the graphs, because what we just found out today, that we are officially in the 7th recession that I've been selling through in the last 45 years. And people are so worried. Interest rates going up. We just heard interest rates went up 3/4 of a point. Now we're officially in a recession, and everyone's kind of freaked out what's going on with the real estate market. Well, let's look at our first graph. We talked about this a couple weeks ago. The recession doesn't equal a housing crisis. You'll see in 4 of the last 6 recessions, the real estate prices actually went up, including during COVID. And in 1991, they just barely went down, basically stayed the same. It was only in the Great Recession of 2008 that real estate prices went down significantly, because real estate drove us into the recession. But there's so many other things going on with the economy. Real estate is driving us into this recession. You know, what is basically slowed the market down is a couple different things. Obviously, a lot of people are talking about the interest rates. And now the Federal Reserve just raised the interest rates 3/4%. And people think, oh my God, rates are going to go up from 5.5 to 6.25. Well, that's not the case. If you remember last month or so, when the Fed raised the interest rates 3/4%, interest rates, mortgage rates actually went down. And the reason why is because the lenders know that the Fed, the money that they loan the banks to, is going to go up. So they bake in an increase already. So what happened when the interest rates went up 3/4% a month ago, rates actually went down. So we'll see. Now, they literally just yesterday raised the Federal Reserve rate 3/4%. But remember, that's not what they loan for houses. That's basically for cars, for credit cards. That's the money that they loan to the banks. It doesn't equal an automatic increase in mortgage rates. But we'll see. And next week, tune in and we'll kind of tell you how that is affecting the interest rates. But look at this graph, the 30-year fixed rate. You can see that we're right about 5%. They've jumped up a little bit, gone down a little bit, but they expect them to stay right around 5% or so. And except for 2020 and 2021, this is where they've been. It's kind of like, I drove by the gas station the other day and I saw gas at $5.50. I'm sitting there going, oh my God, gas prices went down. And so it's amazing that $5 to $6 gas is now the new normal. Well, it's the same way with interest rates. Interest rates now, 5%, 5.5% is the new normal. Will they creep up a little bit? Absolutely. They'll probably creep up a little bit more, because the reason the Federal Reserve raised another 3/4% after just doing it a month ago is because inflation is still out of control. But yet, what is the best hedge against inflation that we always talk about? It's real estate. That's why real estate is still one of the best investments out there. And if you're a buyer, you definitely want to be in this market. So you want to be a smart buyer. It's a good time to be a buyer, and it's a good time to be a seller. Good time to be a seller because, no one's expecting prices to really jack up a lot. They're either probably going to stay about the same, or they're going to basically maybe go down, maybe they'll do a little bit more correction. Or if you're a seller and you plan on selling the next couple years, why not do it now? Now, if you're a buyer, there's going to be some great values out there in the next couple months. Now, as a buyer, you might sit there and go, well, what if I buy in 2 months and they go down another 5%? Well, if interest rates go up 1/4%, that's going to offset if you would have paid just a little bit more. Very hard to purchase at the bottom of the market, because we don't know what the bottom of the market is until it's already started going up. Look at this graph and you see mortgage rate projections, through the next quarters of 22, 23, all through 23, basically right around 5%, where you saw on the other graph, which, except for the last 2 years, is pretty normal. A lot of people are also talking about distressed properties. What's going to happen? Is there going to be foreclosures? There is no way. Look at this graph. Look at where distressed sales, foreclosures, and short sales are. And they're not going to pick up. Maybe just a little bit here and there. But the reason they're not going to pick up is because If you've owned your home only for a year, it's gone up like 30%. So people, when a market corrects 10%, now the market just corrected 10%, 20% like in San Ramon. You don't see people like rats on a ship jumping off. The reason why and going into foreclosure and short sales is because the market's literally gone up 50, 60, 70% the last couple of years, so people still have plenty of equity. That's why short sales and foreclosures are almost non-existent. You know, home sales essentially have returned to the levels in 2019 prior to the pandemic after 2 years of gangbuster performance. So you have a situation where we're kind of in the new normal. We talked about this last week, where you have a situation where there are about 500,000 homes for sale in the United States. Well, that's about 3 times what there was a few months ago, and people are going, oh my God, look at all the inventory. But a normal amount of inventory during this time would be 1.2 million. So it's still less than half what is normal. I used the example a couple weeks ago of Blackhawk. Blackhawk had a situation where in 2008 there were 200 homes on the market. Well, if we ever got less than 50 homes, we would usually say there's no inventory on the market. And then we got all the way down to just 5 homes on the market. Now we have 20 homes on the market and people go, oh my God, there's so much inventory. And it's still less than half what 5 years ago we would consider low inventory. We're still in a seller's market. Average homes on the market, 1.5 months, went up to 2.5 months. Anything less than 6 months on the market is considered a seller's market. So we're still in the seller's market. There's still a lack of supply out there. The millennials are in the peak of their buying season. Home builders have built 6 million homes less than they normally would have built the last 14 years. And interest rates are still relatively low. And you have a situation where a lot of people out there are in 2.5%, 3%, 3.5% interest rate. They're not just going to move the move and jump into a 6.5% interest rate. So you're not going to see a flood of new homes hit the market. So the supply and demand is still going to favor the sellers. That's why during this next recession, I think the market's going to stay fairly stable. Maybe it might even go up a little bit, might go down a little bit. But again, the world economics, you know, definitely will dictate that a lot too. Existing home sales, you'll see, they expect about 5.5 million home sales this year. Well, last year was 6.1 million, which was, again, 2021 was just a nuts year. You can hardly even count that. But if you look at 2017, 18, 19, and 20, that's about average. So we're really just back to what we would say is a strong real estate market right now. Months of inventory of homes, like we talked about before, at the low there was 1.5 months. Now there's 2.5 months. Well, anything less than 6 months is considered a seller's market. You know, the best analogy, and I talked about this in weeks past, is not the market. If you're going around a corner and you're on a road and you're going 60 miles an hour and the speed limit is 40 miles an hour and you go around a corner and 3 blocks ahead you see a cop car, you're not going to slam on your brakes. What you're going to do is start decelerating. And that's kind of what the market's doing right now. It's just decelerating down. And we did have a correction. It clawed back the appreciation that's basically happened the last 3 or 4 months. So now we're into a point where, you know, the market is fairly stable. And you'll see it. Look at the graph on the San Ramon market. You know, before, what we knew happened over this month of correction, there were basically, you know, this many pendings and this many active properties. Well, over a month, it completely reversed, where now we have way more active properties than pending properties. But look at the last 3 weeks on these graphs. You'll see that active properties have stayed absolutely stable. Pending properties have stayed stable. And you'll see that in all the different markets. So what does this tell you? Well, the market corrected, and now it has stabilized a little bit. But it's still stabilized. If you drop me in, if I got back from a 3-year vacation and you drop me into the market right now, and I looked at this graph, I would tell you it's a seller's market. But because of what we've been in, we were thinking, oh my God, the market is crashing. And actually it corrected and then it stabilized. Same thing, you look at Danville. Danville, the same thing. Active properties and pending properties have stayed fairly stable. Blackhawk market, same type of thing. Even actually inventory's gone down a little bit, but for the most part it stayed stable. Same thing with Alamo, pretty stable. And then same thing with Dublin market, pretty stable as far as actives compared to pendings. So really the market has stabilized quite a bit. It corrected, and depends what area you're in. San Ramon had a ton of appreciation the last couple years, so that market crashed a little bit more, 10 to 20% across the board. Danville, Alamo, 5 to 10% across the board. This is the thing we talked about, the sold price to list price percentage. If you remember a couple weeks ago, I said you're going to see everything about 100%. And sure enough, look at San Ramon 99%, Danville 101, Blackhawk 98, Alamo 98, and Dublin 97. Well, you have a situation where I was kind of hoping Danville would be below 100%. But in actuality, it really is, because I just checked the hot sheets today and there were 13 price reductions in San Ramon. So if a property's asking $2 million and it lowers to $1.8 million and then it sells for $1.8 million, it's going to show on here at 100% of asking price. In reality, it's already basically dropped 10%. If you were to take these percentages based on where a property started at, I would say that probably you'd be down to like 90 to 95%. And so pretty soon, watching the market, because what we have now is we have more transparent pricing, because we don't have as many offers. So you can't, if a property is worth 1.9, you can't put it on for 1.6 and think it's going to get bid up to 1.9 to 2 million. Transparent pricing is where we price a home where we think it's going to sell. So we put that home on the market for 1.9 and expect one offer, maybe two offers, maybe a little negotiating back and forth, but for the most part we're putting homes on the market where we think they're going to sell. The other thing that we're doing, if you watch some of our videos of how we get a home ready, there's a lot more competition out there. So we are literally, we have to get homes ready to sell. The Warren Buffett basically said you can always tell when the tide goes out, you can always tell who's not wearing the trunks. And that's what we're going to see in the real estate market. The agents that have basically just put homes on the market are basically, they're going to be exposed. But the agents that work the listings, expose the listings, like the Kehrig team, you're going to see them continue to thrive and their listings continue to sell for top dollar. Again, every market's a little bit different. If you want more information, give me a call. Even within a neighborhood, every home's a little bit different. Put my 45 years of experience to work for you. Give me a call, Joe Kehrig, 925-487-6838, or drop me an email, joe@kehrigteam.com, or visit our website to see all of our listings out there and learn more about the Kehrig team, www.kehrigteam.com. Have a great week, and we'll see you next week.